So Brandon, if you could, can you please go through some of the differences that you see in terms of managing the Cambridge Canadian Equity Fund relative to the First Asset Core Canadian Equity ETF?
Sure, and the Canadian Equity Fund clearly has been around for almost a decade now. And one of the big things we did when we came over from Fidelity with that fund is we wanted to manage it very actively, and that meant we didn't have sector allocations that we had to adhere to. We did not have a geographic allocation we had to adhere to. It had to be 50% Canadian equities at all time, but the balance could go into the US and other parts of the world. The other aspect is that we could be very active with our cash management. And one of the things that we know over time, in my career, there are times to be in the market and there are times to not be in the market. And so being active with your cash can add a lot of value over time if you are focused on the right subset of companies and you have a target price and an intrinsic value you're willing to buy the company at when that opportunity arises. So the Canadian Equity Fund is a mixed geographic benchmark. It can go up to 49%, as I said, outside of Canada, and the vast majority of that tends to be in the US. And so when I think about that product, I am thinking about a North American product. I'm investing it on behalf of Canadians to provide access to the entire North American product. Now, the flexibility we have on both a geographic perspective as well as a cash perspective in that product is something that some advisors like to use for themselves. So when we launched the ETFs, we really took a couple of those degrees of freedom away from us as the managers and provided them back to advisors. So the two items there are the geographic allocation. So rather than the Canadian Equity Fund, I will decide how much of that fund is in the US versus Canada. We provided two pieces of the puzzle to advisors, one Canadian and one US. You'll see a significant overlap between the securities in the two ETFs compared to the fund itself, but that allocation will be driven by my decision making, whereas the ETFs, the advisor can take that decision making for themselves. The second part is, as ETFs, they can be actively traded, and so the cash decision, well, it makes a lot of sense for me to take the cash decision in the mutual fund based on my bottoms-up analysis, understanding where risk reward is and how much cash I actually want to have on the sidelines waiting for more opportunities. The ETFs provide that cash decision back to the advisors. So the ETFs will be up to 10% cash at any point in time, but substantially fully invested as time goes on in our best ideas.